Happy New Year, everybody, and welcome to episode 133, the first episode of 2018. This is your host, Peter Renton, founder of Lend Academy and co-founder of Lend It. Today's episode is sponsored by Lend It USA 2018, the world's leading event in financial services innovation. It's going to be happening April 9th through 11th, 2018 at Moscone West in San Francisco. We're going to be covering blockchain, digital banking, and of course, online lending, as well as other areas of fintech. There'll be over 5,000 attendees, over 250 sponsors, and registration is now open. Just go to lendit.com/USA to register. Today on the show, we are talking securitization. I'm delighted to welcome Rosemary Kelley. She is a senior managing director at Kroll Bond Rating Agency, and she has been in the securitization space for a couple of decades now. And she's been at Kroll for many years, where she has really become one of their leaders in the marketplace lending space. And many of you may not realize this, but Kroll is actually the leading agency when it comes to rating these unsecured consumer loan deals. So we talk about what has driven their interest in the space. We talk about how the securitization market is evolving in marketplace lending. We talk about some of the securitizations that breached their triggers in 2015 and 2016. We talk about best practices, the changing economic cycle, and much more. It was a fascinating interview. I hope you enjoy the show. Welcome to the podcast, Rosemary.
Thank you, Peter.
So I'd like to get these things started by giving the listeners a little bit of background about yourself. Tell us sort of what you've done in your career up to this point.
Sure, happy to do that. I am a senior managing director at Kroll Bond Ratings, and I co-head the ABS group at KBRA. And I joined Kroll in 2011 really to start up our ABS efforts. And I focus primarily on consumer ABS, and I lead KBRA's rating practice in marketplace lending. Prior to joining KBRA, I worked at DBRS for a few years, and prior to that, I worked at MBIA Insurance Corporation for 10 years, and all of that was in consumer ABS. And before that, I had worked in banking.
Okay, so you've got a long history in the ABS space. So,
yeah.
So just for those people who aren't fully aware, I mean, a lot of people have heard of S&P and Fitch and those companies, but not necessarily know a great deal about Kroll. So can you just give us a little bit of background on the company and what you guys do exactly?
Sure, happy to do that. So KBRA, the formal name of the company is Kroll Bond Rating Agency, but we go by KBRA. So if you hear me using that acronym, we are a global full-service rating agency, which was established in 2010 by Jules Kroll. And KBRA offers timely, transparent, and in-depth research across various sectors. When we initially started out really in structured finance, including commercial mortgage-backed securities, residential mortgage-backed, single-family rental, and ABS. And we've expanded into corporates, municipal finance, financial guarantee. We have a financial institutions group. We have a group that focuses on project finance, and then some other groups that do funds and insurance. We currently have 275 employees, and we have published over 9,000 ratings. And just in terms of issuers or transactions, we have rated over 1,200 issuers or transactions, depending on what it is, which totals $785 billion.
Wow. We
recently opened an office in Dublin, actually, as our European office, in part due to Brexit, is why we have chosen Dublin. So we're expanding into Europe right now as well.
Interesting. And you're based in New York, right?
I am based in New York, yes.
Right.
But I am supporting the efforts in Europe as well.
Right. Okay. And so then, when did marketplace lending first get on your radar?
Yeah, that's an interesting question, actually. We were first approached with marketplace lending in 2012. So it was actually quite a few years between the time that we first started having conversations with people about it and when we actually rated our first transaction in the space. So during that time, we had several discussions with different platforms and potential issuers, investors, depending on who it may have been that was trying to bring something forward. And, we spent a lot of time really doing work in the space to understand, the different business models of the platforms and the specific risks associated with transactions, backed by loans originated by marketplace lending platforms.
Interesting. So yeah. The first deal. The first deals were unrated, and they didn't even happen until 2013. So
that's right.
So you obviously you spent some time learning about it, and what made you comfortable enough to come into the space and actually provide your first rating of a deal?
Yeah, I think, we did spend a lot of time, and I tend to emphasize that maybe more than people can understand that. It really mean that we did a lot of work to understand the risks. And I think that, we have a very strong team here with extensive background and expertise in, assessing transactions and risk. And, we have people that come from different areas of the capital markets, not just rating agencies. Some people worked at monolines like me, banking. And I think that, we're able to use that expertise to get comfortable determining, the risks associated with the space and developing an approach to rating transactions backed by marketplace loans.
Interesting. Okay. And so, when you look at, Peer IQ does their quarterly securitization tracker, and it's always fascinating to read it. And I was going back preparing for this interview and looking at sort of the league tables, as they call them. And, you have done more unsecured consumer than any other agency. And I was just curious to, obviously you've talked about multiple different, lending verticals that your company covers, but why are you what's attractive to you, or why are you so focused on the unsecured consumer lending space?
Yeah, well, I think that that is the largest area in terms of what we've rated in terms of marketplace. We've done 35 consumer loans transactions to date. We've also done transactions in small business, student loans, and we actually did rate our RMBS group rated one RMBS transaction. I think in terms of the consumer loan, I think it really goes back to looking at the expertise that we have. Prior to rating any of these transactions, we've rated several transactions in the consumer loan space for more traditional consumer loan lenders, such as OneMain and Springleaf.
Right.
And, we have a lot of expertise across consumer sectors. And I think that, once we were able to start rating transactions in the space, we spent a lot of time, like I said before, focusing on the business models, management team, looking at, the operational strength of the platforms. And we boil that into a very detailed pre-sale report that investors could then use to understand, what they're potentially investing in. And it shows our rationale for the particular ratings in the transactions. And I think that, investors and issuers have looked at that, and I think they appreciate, that we've been thoughtful in terms of our approach in this space. And I think that's really helped us to, develop, with a number of different issuers in the space. Right.
Okay. And so then, looking back again, if you go and look at the history of unsecured consumer over the last 4 years, as I said, the first deal didn't even get done until 2013, and I think the first rated deal, I think SoFi did it in 2014, I believe. But anyway, so you've got a reasonably short history, but it's been growing quite dramatically over this time frame. From your perspective, what's driving this growth?
Sure. So I think you're right, Peter. We have to go back and look at, in the beginning, there were several deals that were done that were not rated or, and it took time, I think, to really develop this, I'm not going to call it a sector, but really the space. I think part of the problem was really having not enough historical performance data for the platforms for, both rating agencies and investors to potentially get comfortable, with us, rating transactions or investors investing in the transactions. I think that also there was not a clear expectations, or, there wasn't clear parameters around what the structure and terms and conditions of these transactions were. So early on, there was a lot of time spent on conversations talking about things like reps and warranties and who would provide them and what that means for securitizations and, what the platforms were willing to offer. And it depends. It's hard to blanket with one specific answer, but I think that there was just a lot of time spent figuring out what is it going to look like going forward. And now that we have established, transactions for several different issuers that are doing repeat deals and multiple deals, I think that investors have a better idea of what they can expect. Mm-hmm. I also think 2016 was an interesting year in the space. I refer to it, yes, as being more of a transitional year, mm-hmm. because, there were a lot of concerns, early on, even about, funding sources and potential performance issues. And then, we had the events that occurred at Lending Club in the second quarter of 2016 that really caused investors to pull back and caused a lot of the platforms to really, put a big emphasis on making sure that they had the appropriate controls in place, that they had more disciplined underwriting, and were focusing on the performance of loans. And again, put a highlight on the continued need for diversified funding. So I think that, going out of 2016, we've seen, definitely a very large increase from 16 to 17 as we've had, folks kind of getting back to, having a more, I guess, I'm going to say more normal, issuance that they didn't really have at the end of 2016.
Right. And just on that, we've seen this year the new issuance spreads are tightening, it seems. And so what does that tell us now about investor optimism and the acceptance of this space?
Yeah, I think that it tells us that the investors are increasingly getting more comfortable with the asset performance, underwriting, and operations of the platforms, as well as having comfort in the structures. And I think that it's been beneficial that we've seen for some of the earlier deals that we have rated in the space in early 2016, we've already had them come through a surveillance cycle in terms of our sort of regular surveillance to look at how the deals are performing for potential upgrade. And we've been able to upgrade some deals in the space, which has helped investors get comfortable.
Mm-hmm. Right. And so another thing that's changed in the last year, it seems like that everyone has their own shelf now. And, it seems like there's an attempt now to bring, more consistency into the way these deals are structured. But how has that changed sort of the environment, the securitization environment, and the execution of these deals?
Yeah, I think that actually has been very helpful. So we've seen a shift from, deals that were investor-led securitizations. Mm-hmm. So example of that might be the Jefferies securitization for Lending Club collateral that was done at the end of 2016 right. to moving towards more platform-led securitizations. Mm-hmm. And so in the platform-led securitizations, then there could be multiple investors that are contributing their collateral back to the platform that are then included in the securitization. Mm-hmm. And I think that that's been helpful actually for many parties, in securitization, because it helps the platform to have more control over the process. So they can plan out the timing of issuance. It helps with, providing collateral consistency and looking at somewhat consistent enhancement levels and ratings. And it allows the investors to have the option for longer-term financing by selling their loans into the securitization. So the investors that were buying the loans can now contribute them back instead of having to plan out their own securitization.
Right.
And then in terms of the investors in the securitization itself, I think that's helpful for them to know that there's more consistency in the transactions being offered by platforms. So they have a sense of knowing what's coming before, of knowing what similar transactions looked like before they're looking at something new.
Right.
And even if you go back, I mean, before it's maybe like early 2016, we had several different investors speaking to us and inquiring about potential ratings for collateral by one platform. So you could potentially have had competing deals going on, or, everyone might have a slightly different angle. So I think that was going to make things more challenging.
Right. Okay, so I actually want to go back to something you said earlier and touch on sort of the performance issues that you talked, like some of the deals from 2015 and early 2016. I don't know if any Kroll rated deals have done this, but some have breached their triggers in the space. We've got, I think PeerIQ actually lists them as well. But I'm curious to get your take on that, and it seems like maybe the changes you've mentioned just in the last couple of minutes have overcome kind of the negativity of these breaches. But I'd like to get your perspective on sort of the triggers and why it hasn't really tempered investor demand.
Sure. Yeah, I think it's interesting because just looking at the headlines in the space, I think that there were for a time for over maybe 2016 and early 2017, a lot of negative press coming out in terms of some of the deals hitting their triggers. And I think that, there's a lot of reasons for that. And I think it's interesting to think about that, because some of it goes back to what I said earlier about the platforms, the early days of the transactions being securitized. Some of those platforms didn't have as much historical performance data, which makes it more challenging to determine what your expected loss might be for that pool of loans. So, if it's more challenging and if the triggers are set somewhat tight, then you'd be more likely to breach those triggers. And I think that losses had been higher than what was originally expected, potentially. We didn't rate a lot of those deals. But as a result, platforms and issuers have actually tightened underwriting and increased pricing in some segments to try and stem the tide of that. But also looking at how the trigger levels were set, I think there's some other things that's important to look at. The question is, who was setting the triggers to begin with? So it may be that if it was, an investor that was trying to, maximize the, amount of leverage in a transaction, then they may set the trigger tighter, and it may be more likely to breach than, someone else that wants to have more room with respect to those triggers. And it also may be a question of, what were the characteristics of the pool up front? Some of the deals had seasoned collateral, and some allowed delinquent loans in the pool, others did not. So all of those are important in terms of trying to assess the loss timing, essentially, in terms of setting those triggers. But I think the most important thing from the investor perspective is that the triggers are actually set to protect the investors in the ABS deals. So they protect the investors in terms of any potential deterioration in asset performance by capturing additional credit enhancement and paying down the deals quicker. So in terms of investors, it may not be beneficial because it may make the deals shorter. It could be, the deal could pay off much quicker than they expected, and there's potential headline issues, but those triggers are potentially protecting them from any, increase in losses down the road. I would also say that 2017, we saw fewer trigger breaches for, deals that were issued in 2017. So I think that a lot of it related to deals that were done earlier on. And, now that there's more data and more time that has passed, then there's more accuracy in terms of setting those trigger levels.
Right. And, and I've also heard from many people in the industry that 2017 has just been a better year when it comes to quality of underwriting and accuracy of loss rates, expected loss rates. And so I think there's, we're all getting better at what we're doing. And so I think that sort of is part of the whole story as well. But anyway,
definitely.
I want to touch on something for the newer platforms. I mean, there are some newer platforms that I've been speaking to that are planning securitizations in 2018 for the first time. So I wanted to just pick your brain just for a minute or two here on what are some of the best practices for newer companies who are looking to do their first securitization.
Sure. We do speak to folks that are interested in doing their first securitization and try to help to guide them to the extent we can. I think that it's important for the platform to have very clear policies and procedures with respect to how they're underwriting and originating loans, and in terms of how those loans are being serviced. Because I go back to the main factors that I talked to before in terms of what we look at when we assess the risk of a transaction for an issuer, not only in marketplace, but in any space. It goes back to, understanding who is this entity, who's the management team, what's their business model, and we look at what their experience has been, and then how are they applying that at this company. Another important aspect is the historical performance data that I've mentioned a few times. It's important because it helps us to understand initially, looking at the characteristics of what they're underwriting and how they're originating those loans, but then what they're pricing the loans for in terms of performance. They need to have some sort of some performance expectations for a pool, but having historical performance data helps us to then look at, are they performing as they expected, and how do we think that the loans being originated now are going to perform. So I think, capturing that historical data and having a sufficient amount of it is important for getting a rating for a new issuer.
Mm-hmm, mm-hmm.
I would say that it's probably helpful for them to hire an investment bank, which helps them to prepare for the questions and information being asked of them by rating agencies and by investors, and to make sure that they're actually ready to do a securitization. So I would always recommend that as well.
Right. Okay, so I want to go back and talk a little bit about, you mentioned, upgrading deals. You've done, I think I've seen a few of them that have come through where you have issued an upgrade. So what does it take for that to happen? What are you looking for? Is it purely just the performance of the loans are exceeding expectations, or what else is involved in upgrading a deal?
Sure. So we do track the performance of the securitizations on a monthly basis. And we are looking at the transactions themselves in terms of how are the deals performing relative to what we expected at closing. I think it's also important to look at is the credit enhancement potentially building? And in many cases, the way the deals are structured, and actually really the way the deals are structured now, not in many cases, always, the deals have been structured so that enhancement builds over time.
Mm-hmm.
And that has been incredibly helpful for the stability of ratings as well as potential upgrades. And we've seen that, as that enhancement builds, even if losses tend to be a little bit higher than what was expected, that increase in enhancement may be greater than that potential, increase in losses. We also look at the overall, entity itself in terms of what's going on with the entity. Is it relatively stable in terms of how the loans are being serviced? And we take that into account if there's any potential question of, future performance down the road. But I would say that it's important to look at what's going on with the deals themselves and then understand as well what's going on with the company in terms of how that may impact loan performance.
Right. Got it. Okay, I want to switch gears a little bit and talk about the economy. I mean, we're recording this before Christmas, and on the week where the big tax cut is going to come into being here in Washington. So, which people are always talking about a boost to economic growth, and obviously no one knows what's going to happen in 2018, but we've been on this really, this expansion is now one of the largest in history, or one of the longest in history, I should say. But how does that, when you're looking at the macro environment, What are your thoughts on how that's going to impact, the deals you're doing and, the marketplace lending industry as a whole when it comes to, consumer loans?
Sure. So I would say that, the potential, changing economic cycle will impact marketplace consumer loans as it does all consumer credit, meaning, if there is, a change in terms of unemployment rates, an increase in unemployment rates, it will impact, these transactions potentially. And we do look at that in terms of understanding, again, the stability of performance over time that we've seen and what the history of the management team and credit teams have been with respect to originating the loans. It's very important that, we even saw in 2017 that where there were certain segments where there was an increase in delinquencies and defaults, that platforms have adjusted and tightened underwriting standards so that they can potentially try to, stay ahead of any changes in terms of the performance or, adjust quickly so that it's something that they are adjusting constantly to. Mm-hmm. And I think that's very important in terms of just on an ongoing basis that they need to continue to stay disciplined in terms of the underwriting standards that they're applying to these loans, and then also make sure that they're staying disciplined with respect to fraud prevention and, looking at, any other issues that are affecting the performance. And I think that looking at the ratings that we're applying, we do look at the stress levels in terms of potential changes in economic environment that equate to, obviously, as you go up the rating scale, we need higher coverage of losses to get to the higher rating categories. Mm-hmm. And for marketplace deals, because we think that there is a higher risk associated with these deals just because of the relative newness in some of the platforms and looking at the high growth and, many of the fact that it's internet lending, all of these factors we look at to say, do we think that we need additional coverage for losses in marketplace? And we do actually look for higher coverage levels than we would for someone that's more of a traditional lender.
Right. Okay, that makes sense. So you've been around the securitization space for a long time, and obviously you followed what happened in the financial crisis, as did all of us, where these markets pretty much seized up. And I want to get your take now where, we're pretty much almost 10 years removed from that time period. And do you think that the ABS markets in general are in a better position now? Or do you think that, securitization is always going to be cyclical and there will always be times when the markets will just seize up? What are your thoughts on that?
I think that it's important for issuers and securitization platforms to have diversity in terms of the investor base and in terms of their funding sources. And I think that we've seen over time in the financial crisis and at other times that that really is very important in terms of the ongoing ability to maintain business if there is any sort of problem in the securitization market, that they have other sources. So I think that, it's always important to be diversified. And I think that for these platforms, the important thing is for them to maintain a focus on being disciplined and the controls in terms of underwriting, because that's going to help investors to be comfortable even if there is an increase in, delinquencies and losses as a result of some economic cycle.
Mm-hmm, mm-hmm. Okay, we're almost out of time, but just one last question. You've been following this space now for a while. And we've seen a lot of new entrants come in. We talk a lot about Marcus, Goldman Sachs' new platform that has been the fastest growing, and they're holding these loans on their balance sheet. They're not going to. They've gone on the record as saying they're planning on holding these loans to maturity, at least in the near term. But There's many others. I've seen several other banks that have come into the consumer lending space. What are your thoughts on the broader, the competitive environment in this space and the impact that, some of these banks coming into the space is going to have on these, existing, unsecured consumer lending platforms?
Sure. So, we definitely have seen increased competition, and we've seen many of the platforms expanding in terms of the originations volume that they're doing, and not just Marcus. There's other folks coming into the space. And I think that we are going to see increased competition over the next few years in the space. And I think that, again, it's important for the platforms and issuers in the space to go back to being disciplined in terms of how they're underwriting the loans and what sectors they're focused on as we have increased competition. We've seen in other consumer segments increased competition over the past several years since the financial crisis. And again, it always goes back to looking at who are their customer base, what is their business model, who are they focused on, and making sure that as this competition increases, that they're doing what they need to do in order to make sure that the performance is relatively stable on a go-forward basis.
Mm-hmm. Okay. Well, we're going to have to leave it there. I really appreciate you coming on the show today, Rosemary.
Okay. Thanks, Peter.
Okay. See ya.
Bye-bye.
As you look around the industry today, it's very, very different than what it was 3 or 4 years ago, where you've got every major platform now has their own shelf. They're running their own securitization programs. It's becoming a more and more important source of funds for these platforms. Now, having said that, as Rosemary pointed out, the key to success, though, is to have a variety of funding sources, because as we've all seen, these markets can seize up, and if you are 100% reliant on securitization, then you run the risk when the market seize up of really not being able to originate loans. So I think that's happening. I feel like we're in a good space right now. It's going to be fascinating to see how it develops as we get more into 2018. Are we going to see an even more record numbers of deals like we have seen in 2017? Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye. Today's episode was sponsored by Lend It USA 2018, the world's leading event in financial services innovation. It's happening April 9 through 11, 2018 at Moscone West in San Francisco. It's going to be the largest ever fintech event held in the Bay Area, with over 5,000 attendees expected. We'll be covering online lending, blockchain, digital banking, and much more. You can find out more by going to lendit.com/USA.